Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more information like this, please visit adisa.org and check out the resource library. My name is Greg Mausz. I'm your host, joined by Paul Richards. He's a director at NexPoint Advisors. Paul, thanks for joining us today. We're going to be talking the state of residential real estate. And for starting off, I want you to define multifamily versus single-family rentals versus build-to-rent or BTR.
Yeah, well, Greg, first of all, thank you for having me today. I appreciate it. Happy to dive right in. So we define multifamily, more or less 8 units of like 8-unit dwelling or more. So that could be a 400, 500, 600 unit type building. Whereas single-family rental is more or less a single standalone home, a duplex, triplex, and we also, at least at NexPoint, assume quadplexes in a single-family rental regime. For BTR, kind of one and the same. It's just built for a purpose. It's built to rent. It's a contiguous land play, so it's a community of homes. Those can be, again, either single detached, it could be row homes, or duplexes or triplexes, but again, it's all in the same community. So that's how we define built to rent.
Great. So now that we got that out of the way, supply and demand, is there demand equal for all of them at the same time here, or where do we stand?
Yeah, no, that's another great question. Let's maybe start with multifamily. Okay. What we've seen and what the market's seen with multifamily from 2020, 2021, 2022 was just huge starts and a lot of multifamily being delivered last year, this year, and into 25. So you're seeing a lot of deliveries. Absorption is keeping up. It is keeping up, though there are a lot of concessions involved with the current multifamily state. Now, I will say, though, due to the fact of interest rates, which I know we're going to talk about more, during 23, 24, when the Feds decided to have this rate hike cycle, which was 525 basis points in the matter of, I think, 18 months. It's something wild like that.
Very
Tough to get construction financing, for multifamily. And so what happened there? The reverse, right? People weren't starting. People weren't pulling permits. So you've seen this huge drop off in 24. And then you're going to see that going on to 25 as well. So that should moderate, meaning supply-demand dynamic for multifamily should moderate into 25, 26, and 27, which should bode well for multifamily for the supply-demand dynamic. Single-family rental, kind of a different story. Again, you have a lot of individuals from the demographic of from 25 to about 40 who really want to be living in a home. They're starting families, even though it is starting later. But you're seeing robust demand for single-family rental. A lot of it has to do with you're getting more bang for your buck in single-family rental, more per square foot per dollar. So you are seeing a robust demand, at least in a multitude of MSAs. BTR, same thing. It's a higher price point, at least where we dive in. But BTR definitely is also higher demand than most, and we see that continuing into the future.
So where are the best kind of acquisition opportunities now in these sectors?
Yeah, no, that's another great question. Right now, we really like single-family rental, and the reason why is you didn't have this supply glut like multifamily. You're seeing higher gross yields. You're seeing, I think, more robust cap rates and more room for rental growth in the future. So with that, you can really tend to have this untrended type 4 to 5% type NOI growth in the future comfortably. And also the financing, which I know we'll talk about soon too, is also very robust than what you've seen 10 years ago. But there's multiple avenues for financing for SFR.
So you like SFR. Are you buying brand new constructed homes or mostly older homes that need some value add?
Yeah.
Where's the opportunity today, or what do standard SFR managers buy, or is there a standard, or does it just depend on the manager?
It definitely depends on the manager. You have some of the big boys that are buying $300,000 to $450,000 type price point homes that have rental rates of $2,000 plus. You have our lane, which some other operators are in, is more of the workforce value add, in the breadbasket or kind of Rust Belt area where you're finding really good deals as well. And that has to do just with gross rental yields and basically the supply demand in those specific MSAs. So
considering the housing shortage, where do you see development most? Is it going to be SFR or BTR or multifamily?
Yeah, I think right now you do see a lot of BTR. You see a lot of home builders right now, whether it's a DR Horton, Toll Brothers, you name it. They are entering into a lot of agreements with institutional, purchasers. Some of the big boys that are public, a lot of institutionally, maybe private names, but a lot of forward contracts, and they're building directly for these institutional players right now. So I think BTR probably has the most legs in terms of opportunity from a supply dynamic. Still on the MLS with single family rental, you are still finding a lot of deals out there, but with cap rates that make sense. And I think multifamily as well, though. I mean, it has great tailwinds. Like I said, once the supply glut kind of falls off, you're going to start seeing a lot of deals out there that finally pencil.
So that makes sense on that acquisition side. So let's switch gears, talk about these residents and affordability. And they're trying to find really the best place that they can live for their family, that they can afford, the nicest or the best location. Let's talk about affordability for a minute.
Yeah, that's a great question. What we've seen in the market and what you can attest to is back in 2021, you had interest rates for a 30-year mortgage standpoint that were sub 3% sometimes. You're finding 15, 30-year notes that you could get 2.75% to 3%. And so you had a rental versus ownership dynamic that was almost pari passu. It was very even. Ownership's always been a little more expensive in the past few years. It's on average, I think, about 10% more expensive than to rent on average over the past 2 decades. What you see now with interest rates, meaning the 30-year mortgage, is now 6.5% on average. What does that mean? It's about 50% more expensive to own than rent. It's not great for a renter, right? So they're forced to rent, right? Even if they want to own a home, they don't have the down payment for home prices that have skyrocketed. On average now, it's $300,000, $350,000, even $400,000 in some MSAs to purchase a starter home, right? And that supply is dwindled. You're not seeing new construction with these starter homes that are under $300,000, and so it's really put a strain on home ownership. Not to mention, I mentioned this in the past, in terms of demographics, people are now getting married later, having kids later.
Sure.
They want the flexibility. They don't want to be tied down to a fixed asset, right? So they want to be able to rent and be able to move whenever they want. It's the dynamics changed extremely to push to rentership. I don't think that changes anytime soon. Let's just put this into perspective. To make rentership and home ownership the same, or at least on average, home ownership 10% higher, whatever.
Sure.
Yeah. The 30-year mortgage rate would have to get down to about 2.5% to 2.75%. Do you see that happening anytime soon?
No, not anytime soon.
That's 300 basis points of compression that I don't think that we'll see, given that you're looking at the short end of the curve. The SOFR curve, we think at 26 will be around 3% to 3.25%. I don't think you're going to see a negative curve for a prolonged period of time, or at least in a stable economy. That should be upward sloping, right? That means the 30-year Treasury should be 3.5%, 4.5%. So there's no way that a 30-year mortgage, which has a premium to the 30-year, right, would ever see those levels in the near future. So I think affordability is going to be an issue, and I think that's why we do like rental homes. We like residential.
Sure. So as you're out there developing, buying, let's talk financing. And first, interest rates. What's going on there, and how is it affecting the market?
Yeah, absolutely. Kind of touched on that in the previous question. Interest rates right now, we are seeing reprieve, which is great. We've seen both the short end of the term with the Fed cutting SOFR by 50 basis points, or the Fed funds rate by 50 basis points. So now we're at that 4.75% level. We expect another 2 cuts, maybe 3 cuts here by the end of the year. And like I said, the forward curve looks to be about 3 to 3.5% in terms of a place where it's equilibrium, if you will. That's great. And you've also seen the other, the belly of the curve, meaning the 5, the 7, the 10-year treasuries come down as well. Albeit, I know the past week's been a little volatile, but you've seen that come down. So what does that mean for investors? What does that mean for individuals that are trying to finance their multifamily, single-family rental, BTR projects? Deals are finally starting to pencil a little more. They don't have this negative leverage component, or that negative leverage component's diminished a lot, and you can finally have a little breathing room in the future years where you're underwriting NOI growth, et cetera, and having a positive ARB to your debt. So it's been very positive lately.
Okay, so let's look at the other component of that, which is sources of capital. Who is funding all of this development acquisition?
Yeah, great question again. So what you saw in 23 were regional banks, all lenders, life cos, et cetera, kind of just fall back and be like, we have problems. We have a lot of office exposure. We can't lend to you, even if it's residential and makes sense. Maybe it doesn't make sense. It doesn't matter. They pulled back a lot, and so funding sources were diminished. What you've seen in the end of 23 and into 24 are kind of all markets, at least from what we've seen, come roaring back. Whether it's life cos, whether it's the agencies. Agencies have always been there. It's just that the spreads were a lot wider, right? And now they're finally starting to compress. And the CMBS markets have come roaring back, which has been a huge source to a lot of individuals in the residential space, from senior CMBS buyers, mezz buyers, even the subordinate buyers. The spreads are compressing a lot, so it's really making a liquid market in the CMBS space. So deals are again starting to make sense, starting to pencil.
So it seems like there's a lot of good movements, a lot of good things happening in the residential market to create more supply, to kind of fix that. How do you think the performance is going to be in this sector as compared to other sectors in real estate?
Yeah, another great question. I think from what we talked about with the affordability crisis, demographics, meaning people don't want to be tied to their home, and you have the millennials shifting into kind of that pool. I really do think that there are massive tailwinds for residential, and going on the next 5, 10, 15 years, it should outperform other sectors of real estate, whether that be data centers, industrial, hotel. I think is another one that we massively outperform. It's just consistency and it's durable cash flow that you can forecast in the next 5, 10 years and be comfortable with those assumptions. And so we're very bullish on residential all across the board, whether it's multifamily, SFR, or BTR.
So Paul, thank you for walking us through that. Sounds like there's some great opportunity in all different sectors of residential real estate.
Completely agree.
Thank you for watching another episode of Focus on Alternatives. For more content like this, please visit adisa.org. Thank you.